Let me tell you something that changed everything for me. It was 1907. I was 30 years old. I had already made money and lost it more times than I care to remember. The market was shaking, credit was tightening, banks were wobbling, and I could feel it. Not in some mystical way, not because I had inside information, but because I had learned, slowly and painfully, to read what the market was actually telling me instead of what I wanted it to say. I went short. I held the position while the market fell apart around me. October came, and the panic hit hard. Most men were wiped clean. I walked away with about $3 million. Now, I am not telling you this to impress you. I have been broke more times than most people ever win. I lost it all again after that, and again after that. The point of the story is not the money. The point is this. Every other trader I knew in that period was watching the same market I was watching. They had the same information. They could read a ticker tape. They had experience. Some of them had more experience than I did, and yet they were on the wrong side. Or they were not in the trade at all because they had burned themselves on 100 smaller moves before the real one came. The difference between us was not intelligence. It was not talent. It was how we were reading what the market was showing us. That is what I want to talk to you about today. When I was young, barely a teenager, working at a bucket shop in Boston, watching ticker tape scroll past, I thought that price movement was the market. I thought that when something moved fast, that was where the opportunity was. When a stock jumped 10 points in a day, I wanted to be in it. When something dropped hard, I wanted to short it immediately. I was not alone in this. Every trader around me thought the same way. We chased movement. We believed that fast meant important. And for a while, in the bucket shops, that worked, or it seems to work, because in a bucket shop, you were not actually trading the market. You are betting on short-term price fluctuations, and short-term price fluctuations are noise. They are meaningless. The bucket shop does not care whether you win or lose a single trade. It is collecting a spread. And so I could be right often enough on small moves to feel like I understood something. Then I went to trade the real market, and I was destroyed. Repeatedly. Because I was still reading charts the same way. I was still chasing movement. I was still mistaking noise for signal. Here is what I had to learn, and it took me years of losses to truly accept it. Most price movement is not the market speaking. It is the market breathing. It is normal fluctuation. It is the daily randomness of buyers and sellers who have no unified intent. It is noise. The real message, the structural message, is buried underneath all of that. And to read it, you have to stop reacting to every tick. You have to stop treating every fast candle as an invitation. The amateur looks at a chart and sees movement. The professional looks at the same chart and asks a different question. He asks, does this movement matter? Is this the tape telling me something real, or is this the tape creating an illusion designed to pull weak hands into a bad position? Because that is what the market does. It creates illusions. Not because it is alive, not because there is someone behind it plotting against you, but because human nature inside the market creates patterns that consistently fool disciplined traders. And those traders are the fuel that real moves need to happen.
Let me be honest with you about something. In my early years, I traded too much because it felt good, not because it was profitable. There is a feeling that comes when you put on a trade, a sense of participation, a sense that you are doing something, that you are alive in the market. When nothing is happening, when you are sitting in cash and waiting, the absence of that feeling is uncomfortable. I have watched traders, good traders, smart men, destroy their accounts not because they were wrong about the direction of the market, but because they could not tolerate the discomfort of inaction. So they traded. They found small reasons to justify entering. They told themselves they were being active, being engaged, being smart. But they were not trading the market. They were trading their own boredom. This is a critical distinction. Trading to relieve the discomfort of doing nothing is not trading. It is using the market as a way to feel something. And when you are trading to feel something, you are not thinking clearly. You are not reading the chart. You are projecting onto it. The chart becomes a mirror for your anxiety. When you want to be in a trade, you see reasons to enter. When you are already in and afraid, you see reasons to exit early. When you have been sitting in cash for 2 weeks and feel like you are missing out, the next small move looks like the opportunity you have been waiting for. But it is not. It is your impatience making a decision that should be made by discipline. I confess to you that this cost me an enormous amount of money over my career. Not ignorance, not bad analysis, impatience. The inability to sit with nothing happening and feel at peace with it. The professional trader, the one who survives long enough to compound real wealth, learns that boredom is not a problem. Boredom is the condition under which he does his best work. He waits, he observes, he conserves himself, and when the real move comes, he is fresh, he is confident, and he is ready. People have repeated something I said so many times it has almost lost its meaning. The big money is not in the buying or the selling, it is in the waiting. People hear that and they nod, they think they understand it, but then they go back to their screens and they are watching 1-minute candles and looking for the next entry and doing everything the quote warns against. So let me explain what I actually meant. The big money in the market does not come from trading frequency. It does not come from being clever on 10 small trades. It comes from identifying the major trend, the real structural move, positioning yourself correctly, and then having the discipline to hold through every piece of noise that tries to shake you out before the move is complete. The waiting I am describing is not passive. It is not sitting in your chair half asleep. It is active restraint. It is seeing a small pullback inside a major trend and choosing not to react. It is watching the price shake around for 2 weeks near a key level and deciding that the noise does not change your read on the structure. It is having a position that is working and sitting on your hands when every instinct says to take profit early. The waiting is the hardest part of trading because nothing about human nature prepares you for it. We are built to act. We are built to respond to movement. A price that drops suddenly feels like a threat, and every nerve in your body wants to respond to that threat by exiting. But if your analysis of the broader structure is correct, if the trend is real, if the accumulation was genuine, if the fundamental condition that created the move is still in place, then the small pullback is not the market telling you to exit. It is the market testing your conviction. The traders who make the real money are the ones who survive that test, who sit through the noise because they understand the structure, who do not confuse a temporary fluctuation with a change in the trend. That is what the waiting means, sitting through discomfort that is not actually danger.
Let me describe how I actually read a market. I was not interested in short-term price movements for their own sake. I was interested in whether those movements were confirming or contradicting the broader structural story. Before I ever think about entering a trade, I need to know the direction of the primary trend, not the daily wiggle, not what happened this morning, the real trend. Is this market going up over time? Is it going down? Is it moving sideways and building energy for something? That question matters more than anything else. Once I know the trend, small movements inside that trend have context. A small decline inside a bull market is a resting phase. A small rally inside a bear market is a temporary rebound. Without knowing the trend, you react to each of those moves as if they are independent events. With the trend in mind, you understand their meaning. This is why I was able to profit in 1929 in a way that others could not. The signs of the bear market had been building long before the crash came. The internal weakness was visible if you were not looking for reasons to stay bullish. By the time October arrived, I had already built a short position over months. I was not reacting to the crash when it happened. I was already positioned because I had read the structure. The amateur enters on the day of the crash and calls himself smart. The professional had been positioned for weeks. The crash was simply the market confirming what the structure had already told him. This is also why confirmation matters so much to me. I do not enter a trade because I have a feeling.
I wait for the market to confirm what I believe. If I believe a stock is beginning a major advance, I want to see it demonstrate that by breaking through a key level and holding. I want to see the behavior confirm the read. I do not want to be in early and wrong. I want to be correct and perhaps slightly late. Being slightly late to a real move is far better than being early to a false one. Here is a concept that took me a long time to fully appreciate. Discipline is a form of capital. Like money, you can spend it. Like money, once it is gone, you have nothing left to trade with. Every time you react to a minor movement that did not require a decision, you spend a small amount of your decision-making energy. You use up a portion of your focus. And across a full trading day, if you have been reacting to everything, every tick, every small spike, every minor dip, you arrive at the moment that actually matters with almost nothing left. You are tired. You have made 12 small decisions that did not need to be made. Your mind is cluttered with the noise of those decisions, and now the real opportunity appears, the one you had been waiting for. And you either miss it because you are exhausted, or you enter it poorly because your thinking is foggy, or you manage it badly because you no longer have the emotional reserves to sit through a drawdown. This is why professionals guard their attention carefully. This is why I did not sit in front of the ticker tape all day watching every move. I needed my best thinking for the moments that actually deserved it. The amateur treats the market like a conversation he must participate in constantly. He feels that if he is not watching, he is missing something. He fears inaction. But the market is not a conversation. It is a slow revelation. Most of what it shows you on any given day is irrelevant to your purpose. Your purpose is to identify and profit from the major moves, and those do not happen every day. They do not happen every week. Sometimes they do not happen for months. In the months when nothing is happening that meets your criteria, the correct action is to do nothing, to wait, to protect your capital and your mental energy, to stay sharp and ready. The trader who has done nothing for 6 weeks and then executes a clean entry on a major structural move is far ahead of the trader who has been active every day and arrives at the major move exhausted, overtraded, and half broke from a dozen small losses.
This is something that sounds simple, but most traders never truly accept. The market does not know you exist. It does not care about your analysis. It does not care about how much you need this trade to work. It does not adjust itself to give you a chance to be right. It moves according to the combined actions of every participant in it, most of whom are not thinking about your position at all. And yet I have watched men, grown men, experienced men, behave as though the market was personally targeting them, as though it waited for them to enter and then moved against them on purpose, as though bad luck was a conspiracy. This kind of thinking is dangerous, not because it is offensive, but because it absolves the trader of responsibility for his own decisions. When I broke my own rules, and I did break them more than once and paid heavily for it, I did not blame the market. I blamed myself. Because the rules existed for a reason. The rules were designed to protect me from my own worst impulses. When I abandoned them, I was not being victimized by the market. I was being punished by my own lack of discipline. There is a clarity that comes from accepting this completely. When the market does not do what you expected, you have 2 questions to ask. First, was my read on the structure correct, and has the structure changed? Second, did I follow my rules? If you followed your rules and the trade lost, that is an acceptable outcome. You cannot control the market. You can only control your process. A loss on a well-executed trade is not a failure. It is the cost of participating in a business that involves uncertainty. But if you broke your rules, if you held a loss past your stop because you hoped it would come back, if you added to a losing position because you could not accept being wrong, if you exited a winning trade early because you were afraid of giving back gains, that is a failure, not of the market, of yourself. The market owes you nothing. It offers you the opportunity to be right about structure and to profit from that correctness, but the offer comes with no guarantee, and it comes with the absolute requirement that you manage yourself honestly. When you can finally sit with that, when you can look at a loss and say, that was my best decision given what I knew, or look at a loss and say, I broke my rules and I will not do it again, that is when you start to trade like a professional. I want to talk about something uncomfortable. Fear and hope are not emotions that happen occasionally in trading. They are present in almost every moment of an active position, and they do something specific to the way you see a chart. They make you find what you need to see. When you are in a trade and afraid of losing, the chart looks like it is breaking down. Every small decline feels significant. Every lower high looks like confirmation of your worst fear, and your mind, working quickly, trying to protect you from pain, begins building a case for why you should exit now, why the structure has changed, why this is not the position you thought it was. But the chart has not changed. The structure has not changed. Your emotion has changed, and because you are searching the chart for evidence that matches your feeling, you are finding it. The opposite happens with hope. When you have a losing trade and you hope it will recover, you begin to see evidence of recovery everywhere. A small bounce becomes the beginning of a reversal. A moment of sideways movement becomes accumulation. Your mind is protecting you from the pain of accepting a loss, so it finds reasons to hold. This is why discipline cannot be applied in the moment. By the time the moment comes, by the time you are in a trade and feeling something, your judgment is already compromised. The only protection is a decision made before the emotion arrived, a rule, a plan, a predetermined level at which you will exit regardless of what you feel in that moment. The professional does not manage his trades by feel. He manages them by plan. He decided in advance where he would exit if wrong. He decided in advance how much he was willing to risk. He decided in advance under what conditions he would add to a winner. And when those moments arrive, he executes the plan. He does not renegotiate with himself. This is also why less is better when it comes to screens and indicators. Every additional piece of information you are watching is another potential trigger for an emotional reaction, another thing that can create fear or hope unnecessarily. The cleaner your process, the cleaner your thinking. I was not looking at 10 indicators. I was reading the tape. I was asking, what is the price telling me? Where is it going? Is that consistent with where I believed it would go when I entered? If yes, I hold. If no, I exit and reassess. That is the whole of it. I want to give you the most important piece of practical wisdom I ever developed. And I want to take the time to explain it properly because it is almost always misunderstood. Sitting tight is not the same as holding blindly. Sitting tight is not stubbornness. It is not refusing to accept information. It is not the belief that because you entered a position, it must eventually work. Sitting tight is the practice of distinguishing between noise and structure and refusing to act on noise. Here is what I mean. When you are in a correctly positioned trade, one that aligns with the primary trend, that was entered at the right time, that is moving in the expected direction, there will be moments when the position shakes. It will pull back. It will pause. It will sometimes look briefly like it is failing. And in that moment, every voice inside you says to exit, to take the small gain you still have, to avoid the risk of watching a profit disappear, to protect yourself. But if the structure has not changed, if the primary trend is still intact, if the move is still developing as you expected, those voices are lying to you. They are reacting to short-term noise. They are telling you to abandon the trade right before the larger move. This is where most traders lose the most money. Not on the entries, not on the stops, but on the exits. They exit correct positions too early because they cannot tolerate the discomfort of temporary drawdown, and they watch from the sidelines as the trade does exactly what they thought it would do without them in it. Sitting tight is the practice of staying in a trade when the noise says leave, but the structure says stay. It requires preparation. It requires understanding before you enter how much movement is normal for this market, this position, this phase of the trend. It requires accepting before you enter that the position will test you, that there will be moments of doubt, and committing before the doubt arrives that you will not act on it unless the structure itself changes. I held short positions through temporary rallies in a bear market because I understood that temporary rallies inside a bear market are normal. They are not proof that the bear is over. They are proof that human nature desperately wants the bear to be over, and that some traders will buy the rally hoping it is the turn. I knew those buyers would eventually be wrong. I knew the structure would reassert itself, so I sat. I tolerated the temporary discomfort and I waited for the structure to play out. The size of the reward from a correct major trade is almost never available to the impatient trader because the impatient trader exits on the first test of his conviction. The real reward goes to the trader who identified the structure correctly and had the discipline to hold through everything the market threw at him before the full move was complete. That is sitting tight. Not stubbornness, active, disciplined restraint in the service of a correct structural read. I want to bring this all together for you now. Everything I have described comes down to a single shift in how you understand what trading actually is. The amateur believes trading is about reacting. He believes the best trader is the one who reacts fastest, who finds the most opportunities, who is most active and most engaged. He measures his effort by how many trades he makes, how many hours he spends watching, how many setups he identifies. The professional understands that trading is about restraint, about identifying the moments that genuinely matter and acting only then, about allowing the countless irrelevant moments to pass without a response, about preserving his mental clarity, his discipline, and his capital for the occasions that deserve them. This requires a complete change in what boredom means to you. To the amateur, boredom means he is missing something. It creates anxiety. It pushes him to look harder, to lower his criteria, to find a trade, any trade, that justifies being active. To the professional, boredom means the market is not offering anything worth taking, and that is acceptable. That is not a failure of vigilance. That is proper patience. That is the correct response to a market that is offering only noise. The real trade, the structural move, the aligned opportunity, the moment when everything you have been observing coalesces into a clear and appropriate entry, that does not come every day. It does not come every week. In some periods, it does not come for months. And in those months, the professional does very little. He observes. He notes what is building. He watches how the structure is developing. He conserves himself. He does not trade because he doesn't have to. He understands that not trading is not failure. It is patience. It is respect for the market's timing. Then, when the moment comes, when the structure aligns, when the confirmation arrives, when the setup presents itself clearly, he enters with size and with conviction. And he holds through the noise because he did not burn his discipline reacting to nothing. That is how fortunes are made in markets. Not through cleverness, not through speed, not through constant activity, through the patient accumulation of correct structural reads executed with discipline, held with conviction, and managed with honesty about when the structure has changed. I have made and lost several fortunes in my life. I have been celebrated and I have been ridiculed. I have sat in offices worth millions and I have sat in rooms with nothing. And through all of it, the lessons I have given you today are the ones that cost me the most to learn. Every time I abandoned patience, I paid. Every time I reacted to noise, I paid. Every time I let hope or fear make a decision that should have been made by discipline, I paid. The market is not a place to prove yourself. It is not a place to fight. It is not a place to extract revenge on your past mistakes by being more aggressive. It is a place to be correct about structure and to have the patience to let that correctness become profit. That is all. The market does not reward the excited. It does not reward the active. It does not reward the man who watches every tick and feels everything deeply. It rewards the patient,
the restrained, the man who has learned through enough painful lessons that the best thing he can do on most days is nothing. And all the days when something must be done, he does it cleanly, with discipline, and without drama. That is the professional trader. Not the fastest, not the most excited, not the most active, the most restrained.